Hello, everybody. Welcome back to the channel. I keep saying I'm going to make these videos short. They always go long, but today I want to cover the AMC covered call position that I have because I want to um, just give you an update so you can kind of follow along, see how it's working. And then I want to talk today about the other type of covered call that you can do and get more into what NVDY does so that you have a better understanding and gradually build your knowledge about these high yield funds, these covered call funds. So anyway, the market overall is doing very well, right? We're reaching all-time highs, and because of that, AMC is also doing very well. And you can see here it's almost gotten up to $5.70. And so now I have to make a choice about my situation. As you can see here, when I sold back here, or like when I got into the trade right around here, it had gotten down to $30. I could have closed it out and then, you know, s waited to sell a call later on at a higher price, but I didn't because my intention all along was to just see what happens, let it play out. There's another 9 days, and then this call will either be exercised or it will expire. But given how AMC is trading above $5 right now, for the person who bought the call, right? It's going to have to get to at least $5.75 for them to break even at least on their investment, right? AMC is currently not at $5.75. However, the person's on July 19th, this call is going to vaporize. It's going to just go away. It's going to poof. And so if this person at least exercises the call, let's assume it stays at $5.42, which is what you see right here right now. The person will recover hopefully $40 or so of the $75. Now, exercising on a Friday, you never know what's going to happen on a Monday. But if all holds up, then on Monday, um, this person will be able to get out and minimize their loss, right? Either lose all their money from the option or lose some of the money. So odds are in about 9 days, this will be exercised. And I'll make my money that I planned, right? If you recall, this spreadsheet and annualization. I mean, pretty good return, right? I mean, annualized, it's almost like 250%. That's pretty good money, right? In just a month, it's pretty well annualized. However, I'm now in a position where I'm doing the thing that that a disciplined trader does not do, which is um, not follow through on the plan. However, at the same time, I do believe with more information, you can advise, you can adjust your trade. So Robinhood's got this thing where it lets you roll pretty easily. What rolling really means is I'm going to buy back the call that I sold and immediately sell a different one. And people do that for a variety of reasons, to be defensive, to try to hold on to their stock, etc. In my situation, I'm just being greedy, I'm gonna be honest with you. And so if I go down and push it out another, it's just 37 days, but really it's another 30 days in my mind. So basically, I'm pushing it out a month. 37 days only because my call technically has another 7 business days. I mean, it's the 19th. Today's the 10th. But, if I would have just let it ride out, I'm going from that date on, if that makes sense. So I'm going to the 16th, excuse me. And I have a couple of options. I could get really greedy. I could roll it up. All right, I could roll it to a higher strike. All right, so I could roll it to the $5.50 strike. I could pick up about $20. You see right now my current call is worth about $58. I could maybe roll and get $20 credit, or because my cost basis on the shares is $4.88, I can do the $5 call and still have it be sold for a price higher than my purchase price. And the reason why that's important is because of something called the wash sale, which is if you sell something for a loss, there's rules about if you get back into that trade 30 days later, it'll get washed out. It's a complicated thing. It's not for this video. I'm just bringing it up to say there's a reason why okay, I was okay. I'm okay at $5. I wouldn't do 4.50, $4.50 because now I'm going to get into that situation, even though the premium is good, but then it's a whole bunch of complicated math. So, um, so, so here's my quick and dirty math analysis for this roll. Okay, the simple way, think about it is buy it back, sell the new one, get $39. Now, since it's a month's time, I annualize it, that's worth about $468. If I take the money that I'm going to get, multiply it by 12, that's $468. Um, my current net cost, I'm using the one from previous month. This is not perfect math, okay? This is not perfect math. I mean, but annualized return on this move, right? By doing what I'm talking about doing, I'm basically picking up 100% annualized return. That's pretty good money, right? Where are you getting 100% annualized return? Well, some of these high yield covered call funds are doing that. Now, a more accurate way I might think about it might be more like this. However, it's still not perfect math because, I mean, I don't want to get into, well, maybe I will in a second. So the net cost is 413 from last time, right? Because last time I did this is 413 is my net cost. And so now I'm going to pull out the $39 I'm going to get from the roll, right? I'm picking up $39 more if I do this roll, which I'm thinking about doing actually. And then that means that now this is going to be $374 is sort of my cost basis, if that makes sense. And then on August 16th, should the $5 strike be called away, I'll collect $500, right? Because $5 strike, option controls 100 shares, so that's $500, less the cash invested 374, right? Because this is my initial cost of 488 minus the money that I've collected, it's 374. So the profit on the date of that sale is going to be $126, which 2% on that is going to be, so if I just use, not 2%, the $126 earned in 2 months on $374 is about a 34% annualized return. 34% on, not annualized, sorry, not annualized. And if I annualize it, it's about 200% return. That's still pretty good. Now, not as good as the initial trade because the initial trade was annualized for about 253. I'm bringing it down my annual return because of the fact that I'm picking up this new roll, but at a lower annualized return. It still isn't perfect math because ideally you wait for the fact that you have to wait your money for the fact that, well, 1 month was at this cost and this next month's at this cost. And I don't want to go through all that math. Okay. I'm not trying to boggle your brain, but so I'm probably going to roll it. Okay. Let's see what happens here. Right. I'm gonna buy to close the $5. I'm gonna sell to open the $5 call here. And the reason why I'm gonna do it is because at that cost basis, I'm gonna be down here like at 3 something. And I feel kind of secure that, around here, it's pretty far below the current price. And the low was about 245. I mean, I could get down there, but then because AMC is sort of volatile and very popular, um, I figure even if it dropped this low, I can still sell enough to make enough money to at least break even. So I'm kind of gambling. I'm going to admit that. This might come back to bite me in the butt. So I'm going to submit now. So I had to adjust it by $1. So I did sell for the 39 like I had put in the spreadsheet. I was trying to hope to get 40, but I don't want to stay here for the next trying to get it done. I want to get this video done. So I ate the dollar for you. I'm just kidding. Anyway, so it's been done. It's completed. So I'm now the seller of an $5 call, 8/16 expiration, and the math will kind of hold up because, like I said, where am I going to get 100% return? Also, part of this for me is just it's enjoyable from like a mental perspective. I just enjoy kind of figuring stuff out. I'm not perfect at the stuff, right? I'm not going to talk about the Greeks that are, not going to talk about the Black-Scholes model for pricing options. I'm just not haven't gotten to that level of sophistication yet. I'm just selling options on a stock that has volatility, and that is worth a lot of money. So now, what am I trying to show you? This is what we call a leap. some people call it a leap because it's just a very long-term dated um, call. So I'm going back to AMC because we've been using this to walk through the process and trying to familiarize you with it. And so you can see here, this is for January 16th, 2026. It's 555 days away. It's about a year and a half. It's very long-term dated. And so um, now keep in mind, right? So a person could either spend $554, $55 to buy 100 shares of AMC right now, or the person could spend $2.61 to buy a call that controls 100 shares of AMC at the $5.50 strike price for $261. But in my situation, I'm going to use this $2.90, okay? So someone could spend $2.90 to control the stock, and then that person could then sell calls on this option. I don't know if that makes sense or not. I'm going to be very careful. So I have visuals are my hands, but rather than spending money to buy the shares, you could spend less money to control the same amount of shares and thus maybe possibly improve your returns. So I'm going to show some math on that right now. And this is important because it ties into what these covered call funds are doing. So hold on. Okay, so I'm just going to keep this very simple. So the cost was $290. If I were to sell the same $5 call at for August 16th, $96, your return would be 33%. This is not a good example. Okay, it's a simple example to show you, this leverage. Because I mean, if you analyze the 33%, I mean, it's like what? It's 400%, 400% return. Okay, but it's a bit of a more complicated problem when you're using longer dated calls as your collateral, so to say, because there's intrinsic value and extrinsic value, right? There's time value. So you never want to really be assigned in this situation. But this is just an example to show you how powerful the leverage is, right? Because you put in much less money and you have so much more power, right? The reason why I'm showing you this example is to say, look, you can have shares, or you can have, to cover your call that you're selling, a longer dated call that's at a lower strike as collateral for the call that you're selling. Oftentimes people call this a poor man's covered call, and they have this call for a couple of years with longer dated call, and they just sell monthly calls on it, hoping to never get assigned, so that they can just keep collecting money. It sounds great if it works, right? Everything's great if it works. Anyway, the reason why I'm getting to all this is because now I'm going to show you what NVDY has. And please don't panic. And I'm not saying I know everything about this. I'm learning as I'm going. Okay, I had to look through it. I had to kind of understand it, but I'm going to show you what's in there. And the one thing I wanted to tell you before going into it is that these funds recreate owning a stock through call it a synthetic stock. And so what does that mean? Okay, if you own a share of a company, if it goes above the price you bought it, you're in the profit, right? You're profitable. And if it goes below the price that you bought it at, you're losing money, right? Okay, so you're losing money. And so a way that companies or people will recreate owning a share of something is to buy the call, like I've been doing, like in this case, right? Buy the longer dated call, but they then sell a put. Okay, a put is something where if you sell a put, that means that you're willing to buy that stock at a certain price. So I'm going to try and explain this using AMC again because you're familiar with it by now, I hope. And so right now, AMC is about $5.45. And so if I wanted to recreate buying this stock right now and I had very little money, what I could do is to do the following, right? I would buy the January 16th, 2026 $5.50 strike call for $2.62. And so now here's the put side of it. Okay, so if I sell the $5.50 put strike, that means that I'm agreeing to buy AMC stock if I'm assigned it for $5.50. AMC could be at $3, but I'm agreeing to buy it at $5.50. So that could be, I could lose a lot of money that way. Okay, but by doing this though, I'm experiencing the full range of the gains and the losses as if I actually spent money to buy 100 shares of the stock. Now, here's the deal. I get $2.62. I spend $2.62 if I buy the $5.50 call. Should be a C there. I didn't put the C there. And I'm getting, if I sell the put, I'm getting $2.40 or $240, right? So my total cost for owning a share, in theory, a synthetic share, is $22. So rather than spending $5.40 per share, I'm spending 22 cents a share, right? So rather than spending $550, right, to buy 100 shares, it's only costing me $22. That's crazy, right? That's tremendous leverage. It's amazing power. Now, you have to have assets. You have to have assets to back up selling a put. Okay, it's a different conversation for a different day. But no company's gonna let you just sell a put where you're agreeing to buy something at a certain price if you can't back it up. So Robinhood would only let you do this if you had $550 that was in cash that was allocated to this transaction. Okay, I'm not going to get into more than that. I don't want to complicate it. But just on a leverage or return perspective, it's a huge difference, right? This is almost 25 times leverage, right? I mean, rather than $550, you're only out of pocket $22. Okay, and so that's what these funds are doing. Okay, so now I don't want to scramble your brain, okay, but I'm about to show you something, and it's NVDY's balance sheet. Now, this is as I understand it, right? I'm not a financial professional. This is not financial advice, right? This is just for entertainment purposes only. I forgot to say that. Forgot to put the disclaimer in there. I'll put it at the end. So right now, if you go to NVIDIA's holdings, NVDY's holdings, okay, you're going to see a whole bunch of stuff that might just cause you to panic, and just don't. Just take a breath. Um, and I'm not saying that to you like, oh, I'm some pro. No, when I first saw it, I was like, holy crap. But you take the time to learn what's in there. And so before I go into the actual calls and puts, I want to talk about this. So it holds a bunch of United States Treasury notes, bonds, right? Different government obligations, and even cash. If you add up these percentages, I mean, they're pretty huge. I mean, 20% of the portfolio is in this, which is straight. So almost all of it's almost a lot of it's cash and cash equivalents. And that's its balance sheet, which it uses to be able to then, excuse me, be able to then sell puts, right? Because the broker knows that, okay, you have all these cash assets here. Um, I just had some fish pills and they're starting to punish me. Some fish oil pills or fish oil capsules. I'm starting to get punished. I don't know why I'm sharing that. I think it's just funny. But anyway, and so this is it. So this is how it secures its trades. It's saying, okay, I have this money, I can back up the trades that I'm making. Okay. So now let's look at what it's doing. So here it's selling these puts. All right, it sold the NVIDIA 816 2024 put at $127 strike. I don't know what the 0.01 is. It might be because it might be trading flex options, which is something I don't want to get into flex options, but it says it can trade in flex options, which is basically options that I guess you can negotiate more specific terms or more one-on-one. They're not, and I don't want to get into it. Okay, The other thing though is it's also then bought this, right? It owns these 816 NVIDIA calls at $127. So it bought $127 the call, it sold the $127 the put, same dates. So it matched. So it created a synthetic stock, so to say. And then it went ahead and sold calls against it. So you look at these calls here, it sold a bunch of 137 calls for July 12th, which will be in a couple of days, and also sold some 132 calls, right? And so if, let's take a look. So right now it's not looking too good because NVIDIA is at $135 right now almost. So it's above, so it sold, so the fund sold calls, I'm sorry, it's not perfect. Right about there, it's not perfect. Just forgive me for, and like 132-ish. So it sold calls that were right about here. So because it's gone above, those calls will be called away. The profit will be capped. Um, and the fund will have to do something about its 127 position, because the 127 position is right about here. So it's got to manage, somehow it's going to have to manage its trade. Right? I don't know if it just buys these back at a loss. I don't know how it handles all that. I'm still figuring out as I go, and I'm sharing with you what I'm learning. So you could see that the security that it used was these $127 calls that are right here, and it sold calls at 132, 133 up here. And so it'll make this money in between. So it'll make the $5, $6 between, but it won't make the rest of it if it stays above 133. All this profit above 132, 133 goes to the owners of the options that were bought, the calls that were bought. So that's it for this video today. I wanted to give you an idea what I was doing on the AMC so you could continue to follow a trade. I wanted to discuss what a poor man's covered call is, what a synthetic stock is, and then I wanted to kind of go through NVDY's balance sheet a little bit and what it's doing so that you get an idea of how it's making its money. Um, right? The issue is right now the market's been very high, and it's so NVDY in particular probably hasn't really experienced a huge down. When the market crashes, there's going to be some pain because, right, it has, if the stock were to crash below 127 before uh, August 16th, it now has to, you know, buy it back, eat it. There's a whole bunch of pain that could be involved. So covered call funds do well when markets are kind of stable and there's volatility, but in a range, or if it's rising. But if the market's dropping, you know, it doesn't seem like it would do very well. Um, anyway, that's about it. Thanks for watching. Once again, not financial advice, just for entertainment purposes only.